join for free and get access to all our notes that we've been covering, which includes Tesla, PayPal, and the likes of other great companies that we've looked at, and specifically the fundamentals and how the company makes money. A lot of what we find a lot of times when people talk about companies is they tend to focus a lot on the numbers and say, oh, great, look at the PE ratio, or look how great the stock's doing. But when you ask them a bit further, deeper about how the company makes money and the strategy and the focus and what the drivers are, that's where they fail. And that's what the Money Cog is really here to help, is to find stock ideas, but actually long-term stock ideas where you really understand the fundamentals and the drivers that drive that company. So today we're looking at Trimble. So why don't you give us a bit of a breakdown of how the company makes money and what is it doing? What does it do? What does the business do?
So Trimble is a lesser known business out there, but it's a technology company that is developing both software and hardware solutions to help companies do things faster. It's all about maximizing efficiency and bringing down costs. And it will take us too long to go over their entire product portfolio because it is extremely vast. They're serving a number of industries, including agriculture, defense, construction, mining, and even works alongside governments at the same time. But if we gave a few examples, or if I gave a few examples, they've got an entire suite of solutions dedicated to automating farming routines to try and, increase crop yield and accelerate the whole process. There's resource planning for infrastructure projects and construction to make sure you keep your costs as low as possible. And it goes on to stuff like advanced GPS, if you like, for like freight and transportation, minimizing the fuel consumption and increasing profit margins as a result.
So wow, it's quite a wide range of sectors, and actually sectors which we can go into a bit more detail, which actually has great tailwinds given the importance of some of those sectors in the future, such as agriculture. You mentioned hardware and software, and it's one of those things where when you look at a company that does hardware and software, you sort of wonder, okay, what's the capital expenditure requirements on the hardware side? So why don't you give us a bit more on depth of how does it actually do the hardware side? Does it produce all of its own equipment, or does it use a third party?
So they all the design aspect is done in-house by Trimble, and they do have their own manufacturing facilities, which obviously adds cost of manufacturing. But the bulk of it is actually outsourced to third parties, and that does provide a lot more flexibility. It allows the company to be a bit more nimble. This is how NVIDIA does things. In fact, they design the chips in-house in the case of NVIDIA, and then they pass on to a third party to manufacture that. It just simplifies the whole process. You don't have to worry so much about supply chains and hiring the right equipment and all this other stuff and complications that comes with it. So by taking that approach, Trimble essentially is able to focus its resources on the design side, which is how it innovates and stays ahead of the competition, in fact.
Okay. We touched on a bit about, okay, we've got hardware, we've got software, we've got the sectors, but what's that revenue mix look like? And where does it sort of get most of its revenue from? And I guess, maybe just go into a bit more detail on that, if you don't mind.
I'm going to share my screen to open up the report because I think it's a bit easy to demonstrate. If you're listening to this as a podcast, the notes or link to notes is in the description below. So in terms of Trimble, its revenue stream is broken down into 4 segments, and each segment is focusing on a different sort of target audience, but they all roughly work in the same way. So you have building as infrastructure, geospatial, resources and utilities, and transportation. I'm not going to read this long list of description, but the notes breaks down exactly which segment targets which audience. But in terms of the revenue breakdown, the majority of it is coming from buildings and infrastructure, which is probably the most mature of those. We've got the details here. But in terms of how they make money, it's all the same sort of fashion. They produce products such as hardware, and those are being sold on to customers. They've got the services side of revenue, where it's additional support services and helping companies integrate their tools, if you like. And then there's the subscription side of revenue, which is a relatively new entry, which we'll go into a bit more detail later on. And that's where they're offering their software solutions as a subscription rather than standalone perpetual licenses, which is how they used to do it in the past. As you can see here, the majority of revenue is generated by selling physical products and software licenses, which is makes sense. That is their core product offering, and yeah, it's by having these three separate revenue streams, it provides a bit of diversity to where the money's coming from.
No, that makes sense. It looks quite simple now that you've gone through the notes, and obviously those who listen to the podcast can click on the link in their own time to look at the note where it gives a nice pie chart and breakdown of how this company makes money. So you've got product, service, and subscriptions. But so am I right in thinking that the company is, so when you've got hardware and software, I mean, we both look at a lot of companies. It's always great to have companies with great annual recurring revenue because you don't have to work as hard for that with that revenue. And once you've got a client, you've just got the recurring revenue coming in, and you just got to service that client or that customer, and that's great to have in a business because it just goes straight down to your bottom line. So, is that where management is trying to focus now, more on the subscription part or more on that recurring revenue, and how much revenue? I think you mentioned the notes, a decent amount of revenue is coming from recurring revenue, which is great. But maybe you want to go into a bit more detail on that.
Okay, in 2020, there was a shift in management. A new CEO stepped up, and we'll dive into management a bit more detail later on. But part of the new strategy as a result of this new leadership is to focus more on selling software as a subscription service, as opposed to the perpetual licenses, which is how it's done in the past. Now, as you said, that gives a lot of advantages. By having a subscription business sales model, it provides recurring income. That makes it a lot more consistent, it improves cash flows, and makes the general revenue stream a lot more predictable. And then that helps when it comes to budgeting and all this other stuff internally. Since he's taken on, the new guys come along, subscription revenue has increased, which makes sense. That's the new strategy. And now it represents about 38.5% of the total revenue stream comes from recurring revenue sources, which is pretty quick turnaround.
Yeah, no, that's very, very, very healthy. Which goes on to the next question really is, we focus a lot on revenue. We talk about revenue, but for those who are new to the Money Cog, and anyway, anyone who's new to investments, I mean, I've seen great revenue drive. You can see great increases in revenue, like 20, 30%, or even 50% year on year, but it's actually what is the associated costs. And what I like to always say is operating leverage which is a term where how much of that goes straight down to the bottom line. Because if you have a large fixed cost, and every time you make a new sale, it goes straight in the bottom line, that's great because your margins are improving, and it's a beautiful thing. So what's the cost structure like here? And I would assume, and for those who don't know, when you look at hardware companies, a lot of it has to go to R&D to make sure it's continuously investing in its products. And you mentioned that one of the revenue streams is obviously building physical products. So how much of cost structures go into R&D, and what is the main components of their cost structure?
Okay, so the cost structure for Trimble is a combination. They've got fixed costs and they've got variable costs. When it comes to manufacturing products, even though most of it's being handed off to a third party, they still have to pay for that service. So the more products they're selling in that regard, the actual hardware, the more they have to pay. So you've got the variable costs there, and pricing power does allow them to expand margins slightly. But that's, if they increase sales, the costs are going to go up accordingly as a result of that. When it comes to the software side of the business, then the costs there are more fixed. You're paying usually the same amount for your programmers, and obviously that scales slightly, but you can scale sales a lot faster, and that allows for profit margins to expand bigger. When it comes to a technology business, they pretty much live and die by their capabilities to deliver on technology. So it's not surprising that a lot of money is being spent on research and development, which is probably a good sign. I mean, if they weren't investing a lot of capital in that department, I don't think it'd take very long for a competitor to come along and start stealing market share by out innovating them. Over the past couple of years, it's remained fairly consistent. It's usually been about 15% of sales, but obviously as sales have been growing, that budget has expanded accordingly. The rest of the expenses is on the usual stuff. You got your general and administrative, which is just day-to-day stuff, and then you've obviously got marketing to go with it.
Okay, seems very simple to understand, and like you said, it's quite encouraging to see that as a percentage, and it's important, like we say, for companies to have R&D. And if you didn't have that, then you sort of think, well, it loses that competitive advantage over the long term. Well, in the short, and that's the thing sometimes people forget is, whilst in the short term, profits might look great, but it's what it's doing with that cash. And we've always said that, right? It's what it's doing with its free cash flow. Is it always giving it back to shareholders, which is great in the short term, but it might not be good in the long term if it's not creating new value or adding new value, especially in very competitive sectors, such as it seems like what Trimble is operating in. So it needs to be on top of things. The next kind of question I have based on notes is, you mentioned in your notes about potential tailwinds of sectors post-pandemic. You know, the world has changed quite a lot post-pandemic, and certain sectors have become hot and more important. So I guess the next question is, are margins expanding as a result of that? Are we seeing more improvements in margins because of the sectors they focused on, and they can charge clients more?
So the short answer is basically yes. With the pandemic, especially for some industries, if we're looking at the engineering sector, especially like aerospace and defense, during the pandemic, obviously a lot of these companies were disrupted, especially like Rolls-Royce, for example. They make a lot of money from servicing aircraft engines for airliners. And when the pandemic came along, no one was really traveling, so the demand for that service didn't exist. In fact, they ended up, I think, firing over 9,000 employees just to try and save money. Wow. So when you now have a sort of a corporate culture, if you like, across all these sort of different companies, desperately trying to cut costs to maintain profitability, especially now where their revenue streams, even though it's pandemic may not be as impactful as it was when it started, but it's still having a significant impact on operations in these companies. So if you're a company like Trimble, which is offering solutions that enable you to run your business more efficiently and save money as a result, because you're not wasting as much time and you're minimizing costs, then that obviously drives up demand. So it's, in terms of, if we look at the revenue, the top line, it hasn't been the fastest growing company out there. I think historically it's done around 8%, but since the pandemic, the revenue has actually started growing faster. It's around 12% now. Which, when you start seeing a sudden uptick in top line growth, either the sales team just got really good or demand has started to climb, which seems to be the more likely explanation in this scenario.
And one of the things that we talk about in our investment guide, as well as that portfolio construction, which people can find and get access to if they join the premium for free. Again, it's on the website, and there's listening to the podcast, www.themoneycog.com. You can join for free premium, and you get the investment guide, which I think we talk specifically about. We talk a lot about portfolio construction, but you know, it talks about recession or things going on. You think that'll be another great driver for this business, because again, you're driving down costs. You know, people using Trimble would be a great way of them driving down costs. I mean, Trimble is not like a sales or marketing ploy where it's not like a sales, it's not and it's not an advertising or agency business, which is driven a lot by where you are in the cycle in terms of people having more dollars to spend. It's much more driven by more efficiency. From a recession perspective, it might do better as people try to drive down their costs, which kind of goes back to the next question, where how has this business sort of been built over the years? Has it been all organic? Have they built their own softwares and hardware, or have they been quite acquisitive in nature? And how have they funded that?
So when it comes to growth, almost all of it is acquisitive in some sense, because this company just seems to be buying like these bolt-on acquisitions left, right, and center. Since 2016, so like 5-6 years ago, they've performed 28 acquisitions, which is quite a lot. Now, there is obviously organic growth as part of the picture here, because when they've acquired the company later on, those companies mature, then that adds in revenue. But for the most part, the recent growth has been driven by acquisitions. They tend to be small scale rather than large mergers, which historically or statistically, it tends to be better at creating value, because if something goes wrong, it's less capital at risk, but it still carries a risk by doing this approach, and consequently their goodwill has built up to over, I think it's around 56% of total assets, which is quite a lot.
Do you want to just explain to people who don't know? We explained it in the notes, so you can look a bit more into goodwill, but what does goodwill actually mean for those who don't know?
It's basically the premium a company pays when it acquires another business. It's marked down as an asset, but in reality it does nothing. It doesn't tend to create value. It's just sort of sits there. But what it does do is very quickly demonstrate whether or not a company is being too aggressive or overpaying for acquisitions, and that tends to be the case when you see goodwill positions as high as this. What we did in the notes, because this is only an indicator, we dug a little deeper. We started looking at how much value was being created based off the invested capital, which is done through a metric called return on invested capital. And despite them being very acquisitive, the return on invested capital is still positive, and it is actually heading in an upward direction, which yes, they may be overpaying for these businesses, but they are generating value from it, and that's ultimately what matters for long-term investors.
Yeah, and the way people can look at the note about how we calculate that. In essence, it's you take your net. If I'm right, is it your net profit or operating profit, and you divide it by total capital plus goodwill, isn't it? Roughly.
Yeah.
Okay, great. Let's go into a bit more about the valuations, and well, we'll talk about valuations a bit later, but a bit more about the stock performance, really. I mean, how does the stock perform? So those who'd be quite keen to maybe look at this in a bit more detail or add it to their portfolio, they probably want to know, well, how's the stock performed over the last 5 years?
So since 2017, if we look at that perspective, the stock is up around 83%, which translates into a 12.8% annualized return. Pretty good. Nothing really to scoff at.
Very good.
But if
no, I was just going to say, if we yeah, carry on.
Sorry. if we ignore, or rather if we measure from 2017 to the start of 2022, before this whole market situation and the whole downturn correction, whatever you want to call it, started, the stock was actually up 137%, which is closer to a 19% annualized return, which is extraordinary.
That's not bad. That's not bad. So I guess, has that been driven by, we always like to talk about in Money Cog, and we've started to think about it a bit more as management, and how management lead these companies and their importance more and more in companies where there's massive disruption and things are changing so fast. You need a strong leadership, strong management. Yeah, I think gone are the days when Warren Buffett said that you'd invest in a company even in India would run. I think you need sort of people who are quite competent and can make quick decisions and strategic decisions that can add a lot of value. So what's been the management story so far? Has it been a long-standing CEO?
Yeah, well, there was. We touched on this earlier. You had Stephen Berglund. He's been running the CEO for many years, but he stepped down in early 2020. And he's still involved with the business. He's now the executive chairman of the board, so he's still around. But the new CEO is a chap called Robert Painter. And even though he's new to the position, he's actually been with the company since 2006. He was working as a general manager when he first joined the business, and he's basically been climbing the ranks. And now he's running the business overall. And his whole sort of strategy as a result of that was something called the Connect and Scale 2025 plan. Which is a very fancy way of saying that by 2025, he wants the bulk of the revenue to come from recurring subscriptions for software licenses, which is what we were talking about earlier, which sounds lovely. I mean, if you can have yourself essentially transition from a software and hardware company to a software and hardware as a service company, the recurring revenue is going to undoubtedly help with cash flows, as well as make a lot more money available to reinvest in the business. It's even with acquisitions. But having said that, it's been 2 years, if even that. And this is during a time when the pandemic is still causing issues. So he hasn't exactly had a very easy role to play so far. So it's a bit too soon to tell whether or not his plan is working. But the early numbers suggest that he seems to be on track. So that's encouraging, at least.
Yeah, that's good. That's good. I mean, it seems, or it's too soon to tell. So it's something we can sort of look and monitor as we go forward. We touched on it a bit more. We touched on it a bit on the R&D side about competition, and we were saying that, well, if they didn't invest in competition in R&D, then they wouldn't have they would have competition. So what does the competitive landscape look like? I mean, you mentioned there's so many different sectors and revenue things that they look at. So what does the competitive landscape look like?
So in some regard, Trimble is similar to Adobe in this respect. We talked about Adobe in the past, a big software company with lots of solutions. Trimble, again, lots of solutions targeted to different industries. And there isn't another company which offers like this level of diversity across its products. But each one of its product lines and its target audiences, there is plenty of competition with it. So if we look at agriculture, for example, you have a stiff competition coming from companies like John Deere and Raven Industries. In defense, you've got Raytheon, which tends to be more established when it comes to government contracts. And with the whole GPS and optical laser solutions, which is what Trimble sort of started out as, they're facing tough competition from an industry giant called Topcon. So they've got lots of sort of small not small. They've got a lot of rivals in different sectors that they have to fend off against, and it's often a very different challenge each time.
Okay. I guess that moves me nicely onto sort of potential threats that you think the business is facing.
So when it comes to threats, the company is obviously peddling in very high technical products. Like, these things need to work. If you're on a mining site, for example, and there's a bug in your code or a piece of hardware fails, that can lead to accidents or, in the worst case scenario, potentially death. So you don't want that. And if something goes wrong and it is as a result of a software bug, they could be liable and face severe legal as well as reputational penalties, which you don't want. Like, that's not good for business.
I think yeah, that's not very good at all. I'm trying to think of examples where I've seen that. But I mean, one thing, I don't know if you've done any work on it, and something I don't remember, I can't remember in the notes, but they have a lot of IP, intellectual property.
Yeah. So this is how it sort of stands out from the crowd a little bit. They have an absolutely enormous patent portfolio. I think they've got over 1,000 entries. It's something bonkers. But beyond the actual protection that these IPs give them, they've been forming with different companies. So, for example, with Caterpillar, which is a big, they do tractors and all this other stuff. They're currently working or collaborating system for earth moving machines. So if you are a surface miner, you could be using Trimble technology and not even realize it. And they have similar partnerships going on with Porsche and Nikon for various other projects. That, because it's essentially working alongside the companies that it's going to be selling products to, or rather the companies that eventually be selling Trimble's products onto their customers, it allows them to sort of fulfill gaps in the market that wouldn't otherwise be immediately obvious.
That makes sense. I guess the most important question is valuations. What do we see as a valuation? Because you can have a great business, a great management team, but at the end of the day, for us as investors, is it worth buying? Is it too expensive? Is it too cheap? What is your perspective on valuation, or what's the Money Cog's view on valuation?
So in the full report, when we analyze these companies, we often use a discounted cash flow model, and baked into that, there's obviously a set of assumptions. When it comes to Trimble, because a lot of their growth has originated from acquisitions, it makes it a bit challenging to forecast, because we can't forecast future acquisitions. We're not clairvoyant. We don't have a crystal ball. But fortunately, in this case, we do have some numbers to work off when it comes to organic growth. And based off organic growth, and when we also take into consideration the new opportunities which are coming forth, especially with 5G technology when it comes to communication between different devices, we are able to essentially forecast the revenue stream and make a bit of a conservative assumption, as well as assume that profitability is going to be maintained and stay in line with industry averages as time goes on. Based off all of these assumptions, which we go into a lot more detail into notes, we found the stock is slightly overvalued today. There seems to be a lot of anticipation for its future projects, but it's worth noting that even though it looks overvalued based off this model doesn't account for any growth that will undoubtedly come from future bolt-on acquisitions. So we'll see.
Yeah, no, makes sense. I guess we talk about, not something that we want to discuss in terms of the actual COG score for this, but do you want to explain a bit, man, what is a COG score in the Money Cog view of the world? I mean, how do we look at what does the COG score represent to us beyond just the valuation that we talk about?
So when we finish analyzing a business each week, we calculate the COG score, and this is our internal metric, if you like, but it's essentially a means of judging a company based off its qualitative as well as quantitative attributes. It looks at stuff like the management team, the threats a company is facing, their competitive advantages, how the financial statements look, what's the sort of corporate culture. There's all these different factors that come into play, and once we finish analyzing a business, we're able to assign a score to a company, and generally speaking, the higher the score, the better. But it's a quick way of assessing the quality of a company?
Okay. That makes sense. I mean, we can't really disclose too much about the COG score. If people want to know a bit more of the COG score, they can obviously join Premium and learn a bit more about that and how it compares with different companies, and they can rank them against the companies that we look at. And then again, for those who want to learn more about the companies we look at, you can go on www.themoneycog.com website and look at all the stocks we've covered. And if you want to watch more videos that we're covering or have ideas or suggestions, leave a comment below. Well, Zaven, it's been great talking to you about this company. And we'll be looking at we'll be looking at the next company next week, which we'll be talking about. Which one was that again? It was what was the company that we're looking at discussing next week?
I think you were going to have a look at Currys.
Oh yeah, Currys, the great UK retailer for technology products. That'll be an interesting one to talk about. Okay, great. Thank you very much, and we'll see you next week. And look forward to speaking about that next week.
Thank you, Imran.